Inflation numbers keep coming out, they're going down, and yet prices keep going up. What's the deal? Why is this happening? In today's video, I'm going to show you why the Federal Reserve has their hands tied and will have to actually reverse course, print a lot of money in the next little while. This will create much more inflation, higher prices are in your future, and I'll tell you why. You came here for the truth, so let me unveil that for you. In this video, we're going to break this down, why this is the case. Throughout, I'll show you all the data that I have right now up until this point to make the case for the Federal Reserve to reverse course on their quantitative tightening policy. What's that all about? I'll give the whole deal and I'll make it real simple. Let's begin by looking at what's been going on with inflation. If you see the news, what do they say? Inflation is going down. Inflation is decelerating. We're having disinflation. Any which way you want to say it. Basically, you could look at it on various charts and in different measurements. When we talk about inflation, that can be measured a million different ways. You use the official government statistics, you'll see charts like this. It was higher previously, now that has come down as the central banks, in this case the Federal Reserve, had been increasing interest rates. That slows things down, and as a result, we can see that inflation has declined. When you look at specifically shelter, that has been the one that has really put the screws in people. There's no question about that. This is showing a lot of real-time data. So it's like Zillow and others where we can see the trend of prices going up has flipped and gone the other direction. So this is just barely, by the way. And what we're seeing is that the prices, they're not going up as much as they did before. That's across the board. That's like a, very broad. When you look at certain areas, certainly the prices are going up. But using real-time data, it is interesting to see what has happened. But what about like real stuff? Like why do we use all these statistics that are not even accurate? I mean, this is what we need to be looking at, and that is the prices in the form of an index of things, of stuff. Well, those prices keep going up. I don't know about you, but when I go to the store, when I have to purchase a service, I keep thinking to myself, where is the ceiling on the price of this thing? Because every time I need to go and do that, it's much more than it was previously. More than it was the month before, more than the year before. Looking back a few years ago, I think, my goodness, I thought it was expensive back then, and yet here we are today. Do you find the same thing? I mean, I've read your comments before, and for so many, it's been incredible. So we're going to talk about the Federal Reserve. We're going to look at what they've been doing, but I just want to acknowledge what's happening here up until this point, right? I think we can all be on the same page with that. So you might ask the question, what's next? What comes of this? First, I want to talk about something here. Investing has changed, and the traditional 60-40 portfolio is now a terrible idea. You need to get into alternative investments. I've talked about several before on the channel, and now I want you to check out this platform. Gigastar Market allows everyday people to invest in their favorite creators. You'll see popular names in the financial space like Clear Value Tax, for example. If you invest, you basically get a financial stake in that YouTube channel's future revenue. Check out the link at the top of the description for more info. What I like about this platform is that you're becoming an active investor. You can do your due diligence and you see a very clear growth trend of a YouTube channel, and you can invest in that similar to how you would with a stock. Remember, the channel creator has an incentive for themselves to grow, and as a result, you're able to potentially benefit from that as well. Today, people are finding themselves investing in assets that didn't even exist just a few years ago, and I would urge everyone to understand the importance of diversification of our assets so that we can make the best use of our capital. So click the link below to find out more about this opportunity. You are looking at a very important chart, and that is the comparison of M2. M2, think of that like the amount of money that's in circulation. And they created in a short period of time, they created, I think it was 40% of all the money in creation before that. All of that was created in like a year and a half, 40%. So imagine that, like snap of the finger, and they created an additional 40% of that money straight up. Anyway, the point here is that that is now decelerated consistently. And what we have seen over time is that when that M2, when the amount of money growth starts to decline, it happens to also coincide with inflation. Now, if that's the case, and it's like, this is, by the way, the M2 is leading by 16 months. So it's just giving us a little bit of insight as to where it's about to go. And if history is any guide, that means inflation is about to go lower as measured by the CPI, okay? And the PPI as well. So that means we are in for what some would consider to be deflation. All right, okay. Hang on to that thought. I want you to understand what's going on. Look at this, housing costs. If shelter costs cool over the next few months, overall inflation could slow below the 3% rate for the first time since 2020. What we're looking at here is the expectation of a big change, something major happening where suddenly prices aren't increasing the way they were before, and that gives people a little bit of breathing room, hoping that wages will go and actually be able to catch up. Is that going to be the case? Let's be honest about that. A lot of people are going to be squeezed. We need to be aware of this. We need to understand that this is a very different world now today. If you remember, Ben Bernanke had some very important things to say over the years, and it was really telling. Here in this quote, I want to break it down really quickly because they talked about the third mandate, the creation of the wealth effect. That's right. Stock prices rose during that period of time before the financial crisis. Long-term interest rates fell when investors began to anticipate additional action, and higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending. Increased spending will lead to higher incomes and profits that in a virtuous cycle will further support economic expansion. So he's talking about this right after the financial crisis, and you got to understand, they're basically saying when we are printing money, or even the suggestion that this will happen, that creates this cycle and it helps. It's the forward guidance. This is going on today. They are telling everybody that wink, wink, nudge, nudge, at some point we're going to be cutting rates. At some point we're going to, by the way, they're not even suggesting that they are going to normalize the balance sheet. They were saying that back then in 2010. Normalize the balance sheet. But now today, they don't. So they're making it very clear that they are going to expand, that they are going to actually go even further. But when? That's the question. When? When is this going to happen, buddy? Well, if you remember last year, I talked about the bottom of the stock market. I said this in September of last year. I said, it looks like it could be the time in which we see at least a near-term bottom in the market. Then about a week or two later, I reiterated that point once again. And now here we are looking back at this. The market, as suggested by the title of this article, by the way, is that the market, investors, are trying to front-run the Federal Reserve's actions. They're always trying to get ahead of that. Now they're pricing it to perfection, but that's what they are trying to do. In the market right now, depending on which you're looking at, it's near or at all-time highs. And you could see this. OECD inflation is at the lowest in 2 years. Looking at the central banks diverging on rates, some are tightening. Some haven't moved at all. Some are starting to cut. And what I would say is that the actions generally move together. You could see a few emerging economies that might be out of whack, but in general, they start to move together. And in these circumstances right here, we could see this trend is the one that is in the future for 2024. Mortgage rates are falling at the fastest pace since the 2008 housing market crash. It was at 8% in the United States, 8%. That started to fall, 7%, and so on. And you could see that this has been going on while the Federal Reserve has still kept interest rates at their level of 5.25 to 5.5. This is important, okay? Because it's always the anticipation. It doesn't necessarily have to be an action that takes place. Fed rate hikes are over, economists say. Here's what experts say you should do with your money. That's right. They're giving you these suggestions, but the point here is that the market doesn't believe. You can look at the actual Fed funds futures, and see that they expect next year that there will be a big change. And part of that is this. I think a lot of people don't understand why this information is very useful, very important. I talk a lot about this on my Finance Friday sessions that I do, live sessions. I'll talk about that. You could see the link in the description under the mentorship. You go down mentorship. But basically what we are seeing right now is that the Fed's hands will be tied. That is supposed to be at a much later date, but I'm here to tell you why this could actually be much sooner than anybody anticipated. Let's check this out. The Fed's continued tightening has come as more than $1.2 trillion has drained from the central bank's overnight reverse repo facility. That's where money market funds earn interest on their excess cash. Well, they've been doing that. They've been parking their money, trying to get some cash to then give back to their investors, right? That's what's been happening. Well, the RRP balances are currently at $839 billion, and the concern is that once the facility is empty, the Fed will have to halt QT. That's quantitative tightening. Now, I know that's really complicated. I know that's a lot. But just understand that this was at like $2.3 trillion a day. That has now gone down to $839 billion. That liquidity is being drained. The Federal Reserve is not there to buy up all this stuff anymore. So the market is supposed to be there like a sponge soaking it up. But there's only so much that it can do. The Federal Reserve needs to be there to actually step in, to actually do this and act like, a stimulus in all cases, all years, never ending. That's what it needs. And the market is basically saying, the investors are saying, you better do this. We are going to go out there. We're going to demand it. So you better do this. And we're going to act as if you're already doing so. And so that is the very big concern, because we don't know what's going to happen. Nobody knows. Certainly I could make a guess, but just looking at it in this way, it is very evident that what we're seeing right now is something that, most people would just gloss over. We can't do that. Look at this. That's just one point. Here's the other. Eyes on the reverse repos. The rapid decline in overnight reverse repos has ignited debate over how soon the Fed may need to end the reduction of its balance sheet. That's right. And so we can see that. For a while there, for a long while, it was seeming like they were just going to go up and up and up and up and up. And, it did stick around that $2.3 trillion a day mark for quite some time. And that is a big, big concern, okay? Reverse repos shrinking fast. You could see, again, same information. This is the concern. Just seeing it at this time, as they say, the Fed has cut its treasury holdings, its mortgage-backed securities by nearly $1.2 trillion since June of 2022, a reduction that has occurred alongside of its aggressive rate rises, which are the main tool to influence the economy. They have repeatedly said that they are cutting their holdings, going to take quite a bit more time. Right. But when does it all end? It's all about liquidity. And the expectation as of now is that they'll be forced to stop QT. It's not like, but Powell said. It is forced. The reverse repo facility is widely viewed as a proxy for excess liquidity that can be easily removed. Closely watch alongside its level of the bank reserves on deposit at the Fed. And by the way, what that means is, like, think about, you have a commercial bank, they can take their excess reserves, okay, the cash that you put in your bank, they could take the excess because it's fractional reserve banking, and they could park that at the Federal Reserve to earn some money on your money, right? You give it to the bank gives it to the Fed. Well, that is what they're talking about there. And while reverse repos have been diving, reserves have not. Big time, in fact. And so I have made this very clear. I call this the money mirror method. I have a video about that. If you look in the playlists on my channel, you will see that. The money mirror method tells you exactly what's going on. And I do cover that on the Finance Fridays live sessions. But what I am seeing very clearly is that there is a relationship between those reserves and the stock market. And on cue, this came into effect yet again. The reserves have been climbing, and so has the stock market. It's like clockwork. The money mirror method is so accurate. And that's why I've been trying to refine it, trying to pay very close attention to it so that I can bring people the information as I see it. I've been looking at this for a long time, and it is very clear to me what's been going on and the direction. I was able to pinpoint that last year because I'm looking at this data. And so I hope that you'll tune in, and I hope that you'll continue to get this information. I'm trying to bring it to you as best I can. If you want the information about that group that we have, just go to the link in the description under the mentorship. Initially it was called mentorship, and you can go here and you can basically see all the details. It gives you everything. Okay. Everything you need to know is on that page right there under mentorship. The link is in the description. The comment of the day. All right. Thank you, Gary. So what'll this next year be called? The crash of 24 or the beginning of the dark ages 2.0? We will see what happens. I am very hopeful that things will be okay. We never know, though. This is the circumstance we find ourselves in, and we can just be informed, be prepared as best we can, and certainly, prepare for the worst, hope for the best. As they say, if you appreciate this information, hit that thumbs up. When you're hitting the thumbs up, it's not just to support me, which I thank you for, but it's also to tell the algorithm, hey, this guy's got some good stuff, and that will actually help go in people's feeds. So I do want to thank you for that as well. I want to ask you to come back tomorrow, where I'll get into some more information each and every day, bringing you the latest and greatest. I'll see you then. Take care.